Welcome back to the show. I want to start today with what might be the strangest investment you'll ever hear me describe. There's a contract trading right now on a platform called PolyMarket that pays roughly a 4% guaranteed annual yield. Mechanically, it works almost exactly like a US Treasury bond. Put $1,000 in. By the end of the year, you walk away with $40 extra in your pocket. Almost zero risk. Almost zero work. There's just one tiny catch. The contract is a bet that Jesus Christ will not return to earth by December 31st. Insiders affectionately call it the Jesus bond, and if you put $1,000 down against the second coming happening this year, you are functionally locking in that $40 profit. Because if you somehow lose that trade, meaning the apocalypse actually kicks off, your portfolio is, frankly, the least of your worries. Pause for a second, because the Jesus bond is not actually a joke. It's a perfect, almost diagnostic example of a strange new financial instrument that's quietly becoming a $100 billion industry. And it surfaces a question that is genuinely worth your time to answer. When you buy a treasury bond, the math makes obvious sense. The government is paying you interest because they borrowed your money to build roads, fund agencies, run the military. There's a real economic engine generating that yield. But who exactly is paying you the $40 on the Jesus bond? That is the billion-dollar question, literally. And the answer is something I think the average retail trader getting marketed these platforms right now does not understand. Or worse, they understand it vaguely, but they underestimate it. So today I want to walk you through how this whole industry actually works, how prediction markets generate their forecasts, why Wall Street is suddenly paying very serious attention to them, and most importantly for you, why the math of the system structurally requires people like you to lose in order for the system to function at all. Let's get into it. First, let me explain what these things even are, because they're not quite stocks and they're not quite sports bets. When you buy a share of Apple, you're buying a fractional piece of a real company. That company makes products, generates revenue, employs people. Your share has a claim on that economic activity. The company grows, your share grows. Simple. You can't buy a piece of an event the same way. A Taylor Swift wedding is not a company. So instead of buying ownership, you're buying what's called an event contract. You're purchasing a yes or no share on a very specific future outcome. Here's how it works in practice. There was a contract on the market a few months back about whether Taylor Swift would get married in Tuscany. If a yes share on that contract is trading at 30 cents, it means the collective community of traders believes there's roughly a 30% chance it happens. If she does get married in Tuscany, the contract settles at $1. You make 70 cents profit on every 30-cent share you bought. If she doesn't, the contract settles at $0. You lose everything. The price itself is the entire product. The platform isn't really selling you a service or a good. It's selling you the collective belief of the crowd, quantified into a clean percentage you can trade. That's the elegance of it. And honestly, it's also the source of every problem we're going to unpack today. Now, I want to address the obvious question, because if I describe that Taylor Swift wedding contract at a dinner party, somebody would absolutely say, wait, that's just sports betting with extra steps. I can go on DraftKings or FanDuel right now and put $100 on the Lakers covering the spread. How is this different? The answer is one feature that completely changes the ecosystem. You can sell these contracts before the event resolves. A sports bet is locked. You put your money down before kickoff and you wait until the fourth quarter. You're stuck with your position. But a prediction market contract trades like a stock. As new information enters the world, the price moves in real time and you can sell anytime. So imagine you bought into that Italian wedding contract at 30 cents. A week later, Taylor gives a magazine interview where she says she's always dreamed of getting married in Europe. The implied probability jumps. Your contract is now trading at 70 cents. You don't have to wait for the actual wedding. You just sell to another trader, walk away with 40 cents of profit per share, and never have to know whether the wedding actually happens. What you're really trading is the volatility of the probability itself. That's a very different beast than a sports bet. And it's exactly why serious money is paying attention. Danny Moses, the investor from The Big Short, has talked openly about using Kalshi and PolyMarket to stress test investment theses. Trading volume on these platforms is staggering. Over the 2026 Super Bowl, more than $1.5 billion changed hands. Kalshi alone saw nearly $10 billion in volume in January of 2026. This is no longer a fringe activity. Here's where I have to give these markets their due, because they really do produce something useful when they function correctly. They're genuinely good at aggregating decentralized information into a single, accurate forecast. The deepest evidence comes from a study by the economists Justin Wolfers and Eric Zitzowitz. Hewlett-Packard set up internal prediction markets among their own employees, asking them to bet on future printer sales. You'd expect the company's official corporate forecasters, the people whose entire job is to model the supply chain, to have the most accurate predictions. They didn't. The internal employee market, driven by people betting their own money, consistently beat the official forecasts. Sit with the psychology of that for a second. A regional sales rep in Idaho might know that a specific printer model is a disaster. The dealers hate it. Returns are climbing. But that rep isn't going to call their boss and deliver bad news to the C-suite. Careers don't survive that. But if they can anonymously short the printer's sales target inside an internal market and quietly make a few $100 doing it, they will absolutely do it. The market literally extracts truth that the corporate hierarchy was suppressing. The same research found that prediction markets predicting non-farm payroll numbers and retail trade data correlated almost perfectly with consensus surveys of 50 professional forecasters. The market just absorbs available information, processes it, and prices it accurately, almost instantly. You saw the same phenomenon during the 2024 election cycle. Strictly as a question of market mechanics, setting aside anyone's politics, at a time when traditional polling was signaling a complete toss-up, the money flowing into Kalshi and PolyMarket was already pricing in a Trump landslide. The financialized markets aggregated and reflected human sentiment far faster than legacy polling infrastructure could. So the forecasting power is real. That isn't in dispute. The question is what it costs to produce it. Here's where I need you to slow down with me, because everything I've just told you sounds great. Smart aggregation, decentralized truth, beats the experts. But it returns us to the original mystery, the Jesus bomb. If these markets are so brilliant, and the smartest money is actively participating, where's the $40 payout actually coming from? In a traditional stock market, multiple winners can exist simultaneously. A company invents a better product, revenue goes up, the stock price rises, the total economic pie grows. Everyone holding shares can win at the same time because real value is being created out in the world. Prediction markets do not work this way. They do not build products. They do not create new economic value. They are, by definition, a mathematically pure zero-sum game. The pie is completely static. For you to win $40 betting that Jesus won't return, somebody, somewhere has to physically lose $40 betting that he will. Every single dollar of profit extracted by a sophisticated winner was directly deposited into the system by a loser. There is no third source of funds. There is no underlying business growing. There is just a wallet that paid in and the wallet that gets paid out. For you to win $40 betting that Jesus won't return, somebody, somewhere has treated that again because it's the entire game. The whole industry is a poker table. And when you sit down at a poker table, the very first thing you should do before anything else is look around and figure out who the sucker is. Because in any zero-sum game, there is always a sucker. And if you can't spot who it is, it's you. The prediction market industry has a built-in catch, 2-2, that defines absolutely everything about how it operates. To have a highly accurate forecasting tool, the kind that beats polling, the kind that Wall Street wants, you need the smartest people with the best information to participate, professional traders, hedge funds, subject matter experts. But those people don't show up for fun. They show up for the pot. They need liquidity. They need a large pool of money to extract profit from. And because the system is zero sum, that liquidity fundamentally requires a continuous, endless influx of casual retail losers. The ecosystem mathematically requires everyday people putting $20 on a pop star's wedding venue or $100 on a long shot political outcome to fund the payouts of the professionals quietly running statistical arbitrage in the background. So what does this mean for the platforms? It means Kalshi, despite all the serious investor branding, despite the Bloomberg terminal aesthetic, despite the regulated US entity status, Kalshi has to operate a lot like FanDuel or DraftKings. Constant promotions, sign-up bonuses, aggressive social media marketing, slick TV ads during the Super Bowl. All of it has one purpose, which is to bring in fresh retail capital. Because the moment that retail money dries up, the professionals drain whatever liquidity remains, the volume collapses, and the entire forecasting machine breaks. I want this to land. The retail traders, the casual users, they are literally funding the accuracy of the forecast with their own losses. The marketing isn't a bonus on top of the product. It's a structural necessity of the product. And it gets worse. Because the people on the other side of your trade aren't always just smart statisticians with better models. Sometimes they have something even more valuable, non-public information. The examples are not subtle, they are glaring. A single user on PolyMarket made over $500,000 correctly predicting the removal of Iran's Ayatollah with timing that was, let's say, suspicious. Massive bets piled up on Maria Corina Machado winning the Nobel Peace Prize hours before the official announcement was public. Sudden, large positions appeared on the ousting of Venezuelan President Nicolas Maduro right before US military action took place. And on a much smaller scale, Kalshi had to ban an affiliate of the MrBeast YouTube channel because they got caught placing bets on the exact metrics of YouTube videos that hadn't been released yet. The CFTC itself has pointed to cases where they allege a US service member used confidential, non-public government information to profit on these markets. Pause and think about what that actually means for you. If you're a casual retail trader putting money on geopolitical events, you are potentially trading against people who already know the outcome, not statistically estimating it, knowing it. And here's the part that should make you genuinely angry. Policing this is almost impossible under existing law. Traditional insider trading requires a breach of a duty of trust. A corporate executive trading on confidential merger information has a clear legal duty to their company and shareholders. Easy crime to prosecute. But prediction markets offer contracts on literally everything. Imagine a contract on whether Costco will raise the price of its hot dog combo. Who has insider information on that? The executive? Sure, but also the regional manager, the supply chain vendor, the graphic designer printing new menu boards, the accountant running the cost analysis. You cannot possibly track a duty of trust across that many people on every contract. Same with Taylor Swift's travel schedule, same with the printer launch, same with the Nobel Committee vote. The sheer volume and obscurity of these contracts makes traditional enforcement basically impossible. Now, I want to take you somewhere that, when I first read it, stopped me cold. His logic, if you really sit with it, is internally consistent. If the goal of the market is pure forecasting accuracy, if you want the price to reflect the absolute truth as quickly as possible, then you actively want insiders to trade, because insiders have the real information. By creating a financial incentive for people with secret knowledge to quietly take positions, you force their hidden information out into the open via the price movement. The market price becomes a perfect crystal ball, precisely because the people who already know the answer are using it to cash in. Read that twice. Because what it really means is that the system, at its theoretical foundation, was designed with the assumption that insiders trading against retail is the engine of accuracy. The accuracy people are marketing the polls beating, expert besting, Wall Street attracting accuracy is generated by exactly the wealth transfer the average user thinks they're not participating in. This is what makes the warning land. The math isn't accidental. It isn't a flaw waiting to be patched. The system was built this way on purpose. And every time you place a casual bet on a contract, you are voluntarily funding the part of the engine that runs on your losses. So we're forced into a really uncomfortable question. What do we actually value? A fair trading environment where everyone has roughly the same information? Or a highly accurate real-time forecasting mechanism that mathematically functions as a wealth transfer from the uninformed to the informed? You can't have both. The industry, so far, has chosen the second. The platforms themselves are not all created equal, and the asymmetry between them is worth understanding. Kalshi is a regulated U.S. entity. They require government ID. They run strict know your customer checks. They actively monitor for manipulation. Average retail trade size is under $100. As prediction markets go, it's relatively domesticated. PolyMarket is the other beast. It's offshore, it's crypto native, it allows users to remain completely anonymous. They technically block US users, but anyone with a VPN can bypass the geo-block in about 30 seconds. And because of that anonymity, PolyMarket is where you see the truly troubling contracts, massive bets on geopolitical conflicts, war, assassination, national security events. The darkest corner of the entire industry lives there. This isn't lost on regulators. 23 Democratic senators recently sent a formal letter to the CFTC demanding the agency outright ban contracts on war, terrorism, and assassination. Their argument is the moral hazard. Even if a forecast is perfectly accurate, do we really want a financial incentive structure existing around global crises? If an anonymous trader stands to make millions on a specific conflict escalating by Friday, does that financial incentive create real-world danger? Does it nudge events? Meanwhile, the CFTC under Chairman Michael Selig is fighting a regulatory turf war to establish federal jurisdiction over these platforms. He's compared this moment to the early days of digital music, Napster versus iTunes. His argument is that if the US doesn't build a legal regulated framework, capital just flows to the offshore pirate versions. States like New York, Massachusetts, and Nevada are pushing back hard, calling these platforms unlicensed sports books, evading state gambling laws. The CFTC sued Illinois, Arizona, and Connecticut to protect its federal turf. They won a major Third Circuit ruling. Translation: the legal framework is still being built around your head while you're already placing bets on it. So let's bring it all the way back to where we started. The Jesus bond pays its $40 yield. That part is real. The math actually works. But now you understand exactly where the $40 comes from. Somebody, somewhere on the other side of that trade, put $40 down on the second coming of Christ. And on January 1st, that money moved from their wallet to yours. But the Jesus bond is the easy case. It's the obvious one. Most contracts aren't this clean. Most contracts pit you against someone who has better data, better models, more sophistication, or sometimes actual non-public information about the outcome you're betting on. So here's the warning plainly. When you walk onto one of these platforms, you are walking onto a poker floor, not a Bloomberg terminal, not an investment platform. A poker floor that has been very expensively decorated to look like an investment platform. The math of the system requires losers to feed the winners. The accuracy of the forecast is generated by people who know more than you. And the legal protections you take for granted in traditional markets, meaningful insider trading enforcement, fiduciary duty, clear disclosure, largely do not apply here. You can still play. Adults make their own choices. But play with eyes wide open. Treat the money you put down with the same expectation you'd bring to a casino floor. Size your bets like entertainment, not investing. And whatever you do, do not let the slick interface convince you that you're outsmarting Wall Street. Wall Street already knows you're at the table. That's exactly why the table exists. So here's the final question I want to leave you with. As we move into a future where every single human event, from a pop star's wedding venue to the price of a Costco hot dog to a global geopolitical conflict, becomes a tradable financial asset with a real-time price tag, does the line between investing, forecasting, and the casino simply cease to exist? I think it already has. The remaining question is whether you know which one you're sitting at. Thanks for going down this one with me. Pay attention to who's holding the keys. I'll see you on the next one.